Question 1. All of the following are characteristics of an adjustable life policy, except A. The policy owner can change the coverage period. B. The policy owner can change the amount of the death benefit. C. It is a combination of term and whole life insurance. D. It allows the policy owner to make withdrawals from the cash value. Answer: D. It allows the policy owner to make withdrawals from the cash value. An adjustable life policy uniquely allows the policy owner to adjust key policy features like the premium, the amount of coverage, death benefit, and the period of coverage, term or whole life, offering significant flexibility. It blends features of both term and whole life insurance, allowing conversions between the two. While cash value does accumulate, adjustable life policies typically do not allow for direct withdrawals from the cash value. Instead, cash value can be accessed through policy loans or by surrendering the policy. Remember, direct withdrawals are more commonly associated with universal life policies. Question 2. An individual applies for a life insurance policy and pays the initial premium. The producer issues a conditional receipt. If the applicant dies before the policy is issued, which of the following is true? A. The policy will pay the death benefit if the applicant was insurable at the time of application. B. The insurer will return the premium to the applicant's estate, as coverage never began. C. The policy will pay the death benefit without any conditions. D. The application will be processed, but no death benefit will be paid. Answer: A. The policy will pay the death benefit if the applicant was insurable at the time of application. A conditional receipt provides coverage starting from the date of the application or medical exam, whichever is later, provided that the applicant would have been approved for coverage as a standard risk. If the applicant dies before the policy is issued but met the insurer's underwriting requirements at the time of application, the death benefit will be paid. This means the insurer is essentially saying, "We'll cover you now, provided you meet our normal health standards." This protects the applicant's family during the underwriting period. Question 3. What is the primary purpose of the Medical Information Bureau, MIB? A. To rate applicants for insurance based on their medical history. B. To serve as an information exchange to help insurers detect misrepresentations and reduce adverse selection. C. To provide a standardized format for medical exams required by insurers. D. To approve or deny insurance applications based on comprehensive medical data. Answer: B. To serve as an information exchange to help insurers detect misrepresentations and reduce adverse selection. The Medical Information Bureau, MIB, is a non-profit organization that acts as a clearinghouse for confidential medical information on applicants. Its main purpose is to help member insurance companies share information to identify applicants who have previously withheld or misrepresented medical information on their applications. This helps insurers prevent fraud and avoid adverse selection, ensuring fair pricing for all policy owners. Think of the MIB as a fraud detection tool, not an underwriting or rating agency itself. Question 4. All of the following are common characteristics of group life insurance, except A. Evidence of insurability is typically not required from individual members. B. Coverage is usually provided by renewable term insurance. C. The policy can be converted to an individual policy upon termination of employment. D. Premiums are based on the age, health, and gender of each individual member. Answer: D. Premiums are based on the age, health, and gender of each individual member. Group life insurance is designed to cover a group of people under one master policy, usually an employer-employee group. A key characteristic is that underwriting is based on the group as a whole, not individual members, meaning individual evidence of insurability is often not required, and premiums are determined by the average risk of the group. While group life is commonly provided by renewable term insurance and offers conversion privileges, individual member characteristics do not determine individual premiums within the group plan. Question 5. The clause in a life insurance policy that prevents an insurer from denying a claim due to misstatements in the application after the policy has been in force for a specific period is known as the A. Grace period clause, B. Reinstatement clause, C. Incontestability clause, D. Entire contract clause. Answer: C. Incontestability clause. The Incontestability Clause states that, after a policy has been in force for a specified period, usually 2 years, the insurer cannot contest the validity of the policy, even if there were material misstatements in the original application. This protects the policy owner and beneficiary from the insurer discovering an innocent misrepresentation years later and denying a legitimate claim. This clause gives policy owners peace of mind that their coverage will not be unexpectedly rescinded after the contestable period. Question 6. Which rider would provide for the waiver of premiums if the insured becomes totally disabled? A. Accidental death benefit rider. B. Guaranteed insurability rider. C. Waiver of premium rider. D. Payor benefit rider. Answer: C. Waiver of premium rider. The waiver of premium rider is a crucial protection that states if the insured becomes totally and permanently disabled, premiums will be waived for the duration of the disability, and the policy will remain in force. This ensures that the policy doesn't lapse due to the insured's inability to pay premiums during a time of financial hardship caused by disability. It's designed to keep the insurance coverage active when the insured needs it most. Question 7. All of the following are dividend options available on a participating life insurance policy, except A. Cash payment, B. Reduction of premiums, C. Paid-up additions, D. Extended term insurance. Answer: D. Extended term insurance. Dividends paid by mutual insurers are a return of unused premium, not guaranteed, and generally not taxable. Common dividend options include receiving cash, applying dividends to reduce future premiums, using them to purchase paid-up additions, additional small policies of the same type, accumulating them at interest, or purchasing one-year term insurance. Extended term insurance is a non-forfeiture option, which allows the policy owner to use the policy's cash value to purchase a single premium term policy for the same face amount for as long a period as the cash value will purchase, not a dividend option. Question 8. A variable life insurance policy is characterized by A. Fixed premiums and a guaranteed minimum cash value. B. Fixed premiums and a death benefit that fluctuates with the performance of the separate account. C. Flexible premiums and a guaranteed death benefit. D. Flexible premiums and a cash value that is invested in the insurer's general account. Answer: B. Fixed premiums and a death benefit that fluctuates with the performance of the separate account. Variable life insurance is a permanent life insurance policy that features fixed premiums and a guaranteed minimum death benefit, but its cash value and the potential for a higher death benefit, above the minimum, are tied to the performance of a separate account, which consists of various investment options chosen by the policy owner. Unlike traditional whole life, the policy owner bears the investment risk, and the cash value is not guaranteed. Due to the investment component, variable life policies are considered securities and require dual licensing, life insurance and FINRA Series 6 or 7. Question 9. An insured has a $100,000 life insurance policy with a $25,000 policy loan. Upon the insured's death, how much will the beneficiary receive? A. $100,000. B. $75,000. C. $25,000. D. $125,000. Answer: B. $75,000. When there is an outstanding loan against a life insurance policy at the time of the insured's death, the loan amount, plus any accrued interest, is typically deducted from the death benefit paid to the beneficiary. In this scenario, the policy had a $100,000 face amount, but there was a $25,000 loan. Therefore, the beneficiary will receive the net amount of $75,000, $100,000 death benefit $25,000 policy loan. Policy loans are considered debt against the policy's cash value, reducing the ultimate payout. Question 10. The payor benefit rider in a juvenile life insurance policy states that if the payor, typically a parent, dies or becomes totally disabled, the premiums will be A. Waived until the insured child reaches a specified age, typically 21 or 25. B. Payable by the child's estate. C. Paid by the insurer for a maximum of 5 years. D. Increased to cover the additional risk. Answer: A. Waived until the insured child reaches a specified age, typically 21 or 25. The payor benefit rider is specifically designed for juvenile life insurance policies. It provides that if the adult payor, the person paying the premiums, usually a parent or guardian, becomes totally disabled or dies before the child reaches a certain age, often 21 or 25, the premiums on the child's policy will be waived. This ensures the child's coverage remains in force even if the payor is unable to continue making payments. It's a way to protect the future insurability of a child. Question 11. Which non-forfeiture option provides the most life insurance coverage? A. Cash surrender value. B. Reduced paid-up insurance. C. Extended term insurance. D. Automatic premium loan. Answer: C. Extended term insurance. Non-forfeiture options are choices available to a policy owner if they stop paying premiums on a whole life or permanent policy that has accumulated cash value. Extended term insurance uses the policy's cash value to purchase a single premium term policy for the same face amount as the original policy, for as long a period as the cash value can afford. This option provides the highest immediate death benefit protection, albeit for a limited time, compared to reduced paid-up insurance which offers a smaller death benefit for life, or cash surrender value which ends coverage entirely. Question 12. What is the primary characteristic of a straight life, ordinary whole life, policy? A. Premiums are payable for a limited period, typically 20 years. B. Premiums are level and payable for the insured's entire life. C. The policy has a decreasing death benefit over time. D. The policy's cash value fluctuates with market performance. Answer: B. Premiums are level and payable for the insured's entire life. Straight life, also known as ordinary whole life, is a fundamental type of permanent life insurance. Its defining characteristics are level premiums paid throughout the insured's entire life, until age 100 or death, whichever comes first, and a level death benefit. It also builds cash value that can be accessed through loans or withdrawals. This structure provides lifelong coverage and predictable premium payments. Question 13. Which of the following statements regarding the taxation of life insurance death benefits is generally true? A. Death benefits are typically subject to federal income tax. B. Death benefits are always subject to state income tax. C. Death benefits are generally received income tax-free by the beneficiary. D. Death benefits are taxable if the beneficiary is a corporation. Answer: C. Death benefits are generally received income tax-free by the beneficiary. One of the most significant tax advantages of life insurance is that the death benefit paid to a named beneficiary is typically received free of federal income tax. This makes life insurance an excellent tool for providing financial security to loved ones without the burden of income taxes on the proceeds. While there can be estate tax implications for very large estates, the direct payout to the beneficiary is income tax exempt. Question 14. An individual purchased a life insurance policy 5 years ago. 2 years after the policy was issued, the insured intentionally misrepresented their age on the application. If the insured dies today, what will the insurer likely do? A. Deny the claim due to misrepresentation. B. Pay the death benefit in full, as the contestable period has passed. C. Adjust the death benefit to what the premium would have purchased at the correct age. D. Refund all premiums paid, as the policy is void. Answer: C. Adjust the death benefit to what the premium would have purchased at the correct age. The misstatement of age or sex clause in a life insurance policy states that if the insured's age or sex was misstated on the application, the insurer will adjust the death benefit to the amount that the premium paid would have purchased at the correct age or sex. Unlike other misrepresentations, misstatement of age is typically not subject to the Incontestability Clause, meaning it can be corrected at any time, even after the contestable period, by adjusting the payout, not denying the claim. This ensures fairness based on the premium paid. Question 15. What is the main difference between a revocable and an irrevocable beneficiary? A. A revocable beneficiary can be changed by the policy owner, while an irrevocable beneficiary cannot be changed without their consent. B. A revocable beneficiary receives a lump sum, while an irrevocable beneficiary receives periodic payments. C. A revocable beneficiary must have an insurable interest, while an irrevocable beneficiary does not. D. A revocable beneficiary can only be a relative, while an irrevocable beneficiary can be anyone. Answer: A. A revocable beneficiary can be changed by the policy owner, while an irrevocable beneficiary cannot be changed without their consent. The key distinction between these beneficiary designations lies in the policy owner's flexibility. A revocable beneficiary designation means the policy owner can change the beneficiary at any time without their knowledge or consent. Conversely, an irrevocable beneficiary designation means the policy owner cannot change the beneficiary, assign the policy, or borrow against its cash value without the irrevocable beneficiary's written consent. This gives the irrevocable beneficiary a vested interest in the policy. Question 16. The period of time after the premium due date during which a policy owner can still pay the premium without the policy lapsing is known as the A. Waiting period. B. Probationary period. C. Grace period. D. Elimination period. Answer: C. Grace period. The grace period is a standard provision in life insurance policies that allows the policy owner an additional period, typically 30 or 31 days, beyond the premium due date to pay the premium before the policy lapses. During this time, the policy remains in full force, and if the insured dies during the grace period, the death benefit will be paid, minus any unpaid premium. This provision prevents accidental policy lapse due to a slight delay in premium payment. Question 17. Which of the following statements about term life insurance is correct? A. It builds cash value over time. B. It provides coverage for the insured's entire life. C. It is designed to provide coverage for a specific period of time. D. Premiums are level and guaranteed for the life of the policy. Answer: C. It is designed to provide coverage for a specific period of time. Term life insurance is pure insurance protection, meaning it provides coverage for a defined period, or term, such as 10, 20, or 30 years. Unlike permanent insurance, it does not build cash value and does not provide coverage for the insured's entire life. It is often the most affordable type of life insurance initially because it only covers the risk of death during the specified term. Question 18. An agent selling a variable life insurance policy must be licensed in which of the following areas? A. Life and health insurance only. B. Property and casualty insurance only. C. Life insurance and be registered with FINRA. D. Claims adjuster and life insurance. Answer: C. Life insurance and be registered with FINRA. Variable life insurance policies, because their cash value is invested in a separate account whose performance is not guaranteed, are considered securities products in addition to being insurance products. Therefore, an agent selling variable life policies must hold both a state life insurance license and be registered with FINRA, Financial Industry Regulatory Authority, typically by passing the Series 6 or Series 7 exam. This dual licensing requirement reflects the investment risk involved for the policy owner. Question 19. All of the following are common non-forfeiture options in a whole life policy, except A. Cash surrender value. B. Extended term. C. Reduced paid up. D. Automatic premium loan. Answer: D. Automatic premium loan. Non-forfeiture options are benefits available to a policy owner if they stop paying premiums on a permanent life insurance policy that has accumulated cash value. The three common non-forfeiture options are taking the cash surrender value, opting for extended term insurance, or converting to reduced paid-up insurance. The automatic premium loan, APL, is a policy rider or provision that allows the insurer to automatically borrow from the policy's cash value to pay an overdue premium, preventing the policy from lapsing. It's a loan provision, not a non-forfeiture option that determines what happens to the cash value if premiums are discontinued. Question 20. Which of the following best describes the purpose of a cost of living, COL, rider on a life insurance policy? A. It provides additional coverage if the insured dies in an accident. B. It automatically increases the policy's face amount to offset inflation. C. It allows the policy owner to purchase additional coverage without evidence of insurability. D. It waives premiums if the insured becomes disabled. Answer: B. It automatically increases the policy's face amount to offset inflation. A cost of living, COL, rider is designed to help the death benefit keep pace with inflation. It automatically increases the policy's face amount, typically tied to an inflation index like the Consumer Price Index, CPI, without requiring the insured to prove insurability at the time of the increase. This helps ensure that the policy's purchasing power remains relevant over time, providing more adequate financial protection for the beneficiaries in the future. Question 21. What is the primary purpose of a key person life insurance policy? A. To protect an individual's family against the financial loss of the insured's death. B. To provide a retirement income for a highly valued employee. C. To protect a business from financial loss due to the death or disability of a crucial employee. D. To fund the buy-sell agreement between business partners. Answer: C. To protect a business from financial loss due to the death or disability of a crucial employee. Key person or key employee life insurance is purchased by a business on the life of an employee whose skills, knowledge, or leadership are considered vital to the company's success. The business is both the policy owner and the beneficiary, and it uses the death benefit to offset the financial losses, such as lost revenue, recruitment costs, or business disruption, that would occur if the key employee were to die. It helps ensure the continuity and stability of the business. Question 22. Which life insurance policy option allows the policy owner to purchase additional coverage at specified future dates without proof of insurability? A. Waiver of Premium rider. B. Guaranteed Insurability rider. C. Accidental Death Benefit rider. D. Payor Benefit rider. Answer: B. Guaranteed Insurability rider. The Guaranteed Insurability rider is a valuable feature that allows the policy owner to purchase additional amounts of insurance coverage at predetermined intervals, e.g., every 3 years, or specific life events, e.g., marriage, birth of a child, without having to prove insurability or undergo another medical exam. This is especially beneficial if the insured's health deteriorates, as it guarantees they can still increase their coverage. Think of it as a future-proof option for your coverage needs. Question 23. An individual who has a life insurance policy with a cash value may obtain a policy loan. What effect does an outstanding policy loan have on the death benefit? A. It increases the death benefit payable to the beneficiary. B. It decreases the death benefit payable to the beneficiary. C. It has no effect on the death benefit, as it's repaid by the insurer. D. It voids the policy if not repaid before death. Answer: B. it decreases the death benefit payable to the beneficiary. A policy loan allows the policy owner to borrow against the accumulated cash value of a permanent life insurance policy. Unlike a typical bank loan, it doesn't require repayment by a specific date, but interest does accrue. If the insured dies with an outstanding policy loan, the amount of the loan plus any unpaid interest is deducted from the death benefit before it is paid to the beneficiary. This means the beneficiary will receive a reduced death benefit. Question 24. What is the purpose of the free look, right to examine, provision in a life insurance policy? A. To allow the policy owner to cancel the policy at any time for a full refund. B. To give the policy owner a specified period, e.g., 10 days, to review the policy and return it for a full refund if not satisfied. C. To allow the insurer to review the policy terms after issuance and make changes. D. To permit the policy owner to make a policy loan without interest during the first year. Answer: B. To give the policy owner a specified period, e.g., 10 days, to review the policy and return it for a full refund if not satisfied. The free look provision, also known as the right to examine, is a consumer protection feature required by law in most states. It grants the policy owner a specific period, typically 10 to 30 days after policy delivery, to review the policy's terms and conditions. If they are not satisfied for any reason, they can return the policy to the insurer for a full refund of all premiums paid, effectively canceling the policy from its inception. This allows for a risk-free review period. Question 25. Which type of life insurance policy is characterized by a level death benefit, fixed premiums, and accumulates cash value, but only for a specific period, after which premiums are no longer required? A. Term life. B. Straight life. C. Limited pay whole life. D. Universal life. Answer: C. Limited pay whole life. Limited pay whole life is a type of permanent life insurance where premiums are paid for a specified limited period, such as 20 years, 20 pay life, or until the insured reaches a specific age, e.g., life paid up at 65. After this payment period, the policy is fully paid up, and no further premiums are required, but the coverage continues for the insured's entire life. It still provides a level death benefit and accumulates cash value, similar to straight life, but condenses the premium payment period.